Good morning or good evening, good afternoon, wherever you are in the world. My name is Greg Fournier. I'm with CIBC based in Hong Kong. And I'm delighted to have the opportunity to spend some time with a very old and good friend of mine, David Garofalo, for this Minds and Money event. We're going to have a discussion on things relevant to the mining sector, the gold sector, and spend about 20 minutes. And I think there's an opportunity for participants to ask some questions along the way. If you want to do that, I think you've got a Q&A bar on the screen. So we would certainly welcome questions. And I think many people will know Dave. Dave's a long-term veteran of the mining industry. Had spent part of his career with Inmet Mining, where I first met him 25 years ago, with Agnico Eagle, with Hudbay Minerals, and lastly with Gold Corp, where Dave was chief executive for many years and was one of the people who put together the combination of Gold Corp and Newmont Mining, which has been one of the major transactions in the gold sector over the last few years. So I want to welcome Dave, and maybe I can start off with a few questions. Dave, your current role, you are the chairman of Great Panther Mining. You're the chairman and CEO of Gold Royalty Corp. You're the chairman of the Marshall Precious Metals Fund. You spent a long part of your career in larger corporate entities, culminating in several CEO roles at large publicly listed companies. You've kind of moved more into what I would describe as a emerging kind of entrepreneurial type of companies, development companies, growth companies. How's that changed things for you, and how are you finding that relative to your previous roles at very large corporates?
Well, I've always enjoyed everything I've done in the mining space over the last 30 years, but the way I position myself more recently has been quite deliberate and strategic, given what I think the industry is facing in terms of its challenges in replacing reserves. Over the last 7-8 years, we've seen a 50% decline in gold reserves across the sector, largely driven simply by depletion, because we haven't been reinvesting back in exploration in a meaningful way. The focus has been very much on generating free cash flow, returning capital to shareholders after a period in the wilderness for the gold industry in the earlier part of the decade. And so I think the focus has been rightfully on returning capital and running these businesses profitably. But what's been sacrificed, of course, is exploration. So I have positioned myself in the earlier stage opportunities in the sector, because I think inevitably, given the downward trajectory in reserves, the industry is going to have to refocus back on exploration, back on filling their pipelines, replacing depleting reserves, and finding the lost art of mine construction, which is generally evaporated over the last decade. There hasn't been any major new mine developments in the industry over the last decade to replace rapidly depleting reserves and soon to be declining production profiles. So Marshall Precious Metals is a fund focused on early stage exploration. And we've seen a resurgence of interest in that over the last 6 or 7 months. A year ago, the juniors couldn't raise money to save their lives, but that market's opened up again. And we're part of that activity in Marshall Precious Metals. And in Gold Royalty Corp, we're about to take a royalty portfolio public that's been spawned out of Gold Mining Inc. And royalty companies have always played a very prominent and important role when producers have focused on mine construction. They've provided relatively cheap sources of capital for mine development. So we're trying to position ourselves in Gold Royalty Corp to provide that type of capital for the emerging producers in the sector as they start to deploy capital in new mine development.
Yeah, I was very interested in your role in putting Gold Royalty Corp together. The royalty space, streaming space, has been one of the great winners for investors in the sector over the years. So it's a great model formula. I guess my question to you is, It's become a pretty crowded space, though. There's a lot of companies out there now competing for opportunities. How do you feel you can differentiate your platform to be successful in winning deals and growing the business?
Well, we're actually getting spun out of an existing public company called Gold Mining Inc. And Gold Mining Inc. has spent the last decade, as gold was really in the doldrums, accumulating inventory or development stage assets at relatively cheap prices. And they have assembled a collection of 14 development stage assets that collectively have over 25 million ounces of gold reserve and resource. And this is an industry that's starved of these pipeline types of opportunities. And one of the strategies that gold mining has undertaken to daylight value in that vast portfolio and that very diversified portfolio is to write royalties on each of those 14 development stage assets and spin it out into a separate public royalty company called Gold Royalty Corp. So my job is to build out the company or build up the organization, hire the people to run the royalty companies as separate and independent public company to raise capital, again, to put into these development stage opportunities. So it is creating a bit of a virtuous cycle. But our intention is actually start to diversify away from that single counterparty focus in gold mining and acquire royalties in our own right and build up a more diversified portfolio of royalty opportunities. And there are plenty out there. I think both in private hands, but also in base metal producers that are starting to deploy capital in the mine development again. Royalty streams on their byproducts has been a very, very cheap source of capital for them relative to what they could raise in the equity markets, because base metal companies trade at significantly discounted multiples to royalty companies and gold producers. So there's an arbitrage opportunity in that. But I also think that there's scope for consolidation. You correctly pointed out there's been a proliferation of these royalty companies that have been spawned over the last couple of years. And I think there will be rationalization over the coming year or two to create critical mass in the royalty space to start to compete with some of the bigger players like Franco-Nevada, Wheaton Precious Metals. And we're well positioned because we've inherited this significant mineral endowment in Gold Royalty Corp. Underlying our royalties are those 25 million ounces of reserves and resources within gold mining's portfolio. And that really distinguishes us relative to these emerging royalty companies that have come out over the last couple of years. Generally, they don't have that kind of long life mineral endowments that gold mining has endowed us with in creating Gold Royalty Corp.
And you've spent part of your career in the base metal sector, a lot of your career in the precious metal sector. You're more focused on precious metals now. How do you kind of think of relative values in those two sectors at the moment, base versus precious metals? And you talk about this arbitrage opportunity that you're trying to be able to take advantage of for a win-win for both your investors in gold royalty and base metal companies. You think that arbitrage is going to continue to be there for a while?
Even in the best times in the base metal space, there's always been that disparity in the valuations between gold companies, gold royalty companies, and base metal companies. Typically in the best of times, at the peak of the base metal cycle, base metal companies may trade upwards of 0.8 to 1.1 times NAV. Gold producers rarely trade down to that level, even at the bottom of the market for gold as a commodity. And today, that disparity has never been wider. Gold companies are trading typically 1.5 to 2 times, at least the established producers, and the royalty companies are trading upwards of 3 times NAV. So the arbitrage opportunity is more pronounced than I would say that it's ever been. So there is that opportunity for base metal companies to tap in to what the royalty companies can raise capital at. They have a much lower cost of capital and take advantage of that arbitrage opportunity to put the work in developing new base metal opportunities. When I was running Hudbay in the first 6 years of this past decade, I did precisely that when we built the Constancia mine in Peru. We raised $750 million from Wheaton Precious Metal in selling a small component of our revenue. It was only about 5% of our revenue was precious metals from Constancia, and we were able to raise $750 million towards the construction of that $2 billion mine. So that was a tremendous opportunity and didn't undermine the economics of that deposit whatsoever, because 95% of the revenue was copper. And so the cost of capital in that was much lower than any of the other opportunities that were afforded to us, whether it was debt or equity, as a base metal producer in Hud Bay.
And starting to get some questions come in, so why don't I turn to those. First one is, I'd love to hear Dave's thoughts on gold M&A in 2021. Where did you see opportunities and synergies?
Look, I still think I don't think it's going to be at the senior ranks. I think for the most part, the senior companies have knocked themselves together. Newmont and Gold Corp came together to create a business that sustainably has 6 to 6.5 million ounces of production for the next 10 to 15 years. They have more than enough within their portfolio to sustain that production profile. Flat's the new growth among the seniors. And Barrick did the same thing with Randgold. They have sustainably 5 to 5.5 million ounces of production for a very, very long runway, if not a decade more. And so there really isn't that imperative for them to run out and do any major M&A. They may do some tuck-ins here and there. I think the opportunity is more in the mid-tier. There's been a proliferation, and emerging producers. There's a proliferation of these companies that have come out over the last few years, single mine companies or small, undiversified mid-tier producers. There's probably too much G&A out there in the industry. That's the next frontier for cost rationalization. I think the industry's done an exceptional job of rationalizing costs at the mine site level, and have enjoyed the opportunities that lower energy prices and weaker local currencies have provided to them. And I think they're at the limit of what they can do there, but they can start to smash themselves together and realize G&A synergies. And they're probably economically incentivized to do that. The biggest impediment to M&A in any industry, not just mining, are social issues. So that's a euphemism for who gets to do what job. And I'd say in this environment, given how gold equities have run, a lot of the share-based compensation of these executives is deeply in the money. And so they're in a position to incentivize to give up their jobs in order to realize the synergies that come from putting these companies together. At the bottom of the cycle, that's a much more difficult proposition. But I'd say right now, a lot of people can keep their chips, cash them, and move on to something else.
Just a segue into a question on the gold market. Gold nearly got to $2,000 again, dropped down to $1,800. One, I guess, two-part question. You kind of mentioned, with gold equities doing well, gold prices doing well. You think that's a help or a hindrance to M&A? Does that help overcome some of these social issues you mentioned? And kind of how do you sort of see the gold price evolving over the next couple of years?
Yeah, look, I talked about social issues. I think with equities at these types of valuations, it's probably an attractive proposition for some of these executives to cash in and move on to something else. It's a much more receptive market to startups, given where the gold prices run. So if you had an established producing company in the mid-tier or an emerging producer, you could very well cash in and then go on and start up something else. Right now, there is capital available for the juniors and the emerging producers that wasn't the case a year ago. So it's much more conducive for entrepreneurs to do startups again in the gold space. Insofar as the gold price is concerned, Merrill Lynch not that long ago put out a gold price forecast of $3,000 within 18 months. And I don't think they pulled that number out of the air. I think where that came from is if you look at the pre-all-time high or the previous all-time high for gold in real terms, you'd have to go back to 1981 when gold was over $850 an ounce in 1981 dollars. You inflate that to 2020 dollars, that's close to $3,000 an ounce. So we're not anywhere close to the cyclical high for gold. And I would say that the environment for gold has never been more constructive, given the amount of money supply that's been introduced to the system, the low interest rates, both on a nominal and real basis, negative. That's unprecedented. So the quantitative easing, I think, is here to stay for the foreseeable future, and that's hugely constructive to gold. And all this debt that's being strapped on at the government level, well, that, those governments are just going to have to inflate their way out of debt. In other words, they're just going to print money. They're never going to repay that debt. There's no conceivable way to do that without strangling the economies.
Let me go to some other questions we've received. Not sure how you want to answer this one. How well are gold CEOs doing running their businesses? Who do you rate and why? I
Well,
like that one.
I think they've all done a really good job. By and large, as you look at the sector, they did a terrible job at the beginning part of the last decade. Coming out of the credit crisis, there was a massive amount of capital invested in new capacity, and that inflated costs dramatically. So even as the gold price achieved $1,900 and north of that, about 10 years ago, gold companies actually saw their profitability go down because their cost inflation outstripped the rise in the gold price. And so investors rightfully got quite frustrated with that. And CEOs in the mining space and the gold space in particular found a new religion in cost containment and returning capital to shareholders. And as I said earlier on, they had to sacrifice exploration in doing that. Inevitably, what happened is reserves came down. But I think that was unavoidable because investors, were demanding that capital be returned, and the companies run their businesses like real businesses in terms of generating adequate returns on invested capital. So I think they've done an exceptional job. And what we have today is an industry that's largely deleveraged. There is virtually no debt. If anything, we're not very efficiently capitalized as an industry because we have very, very little debt on our balance sheets. And that's put us in a very, very good position to start to deploy capital selectively on good exploration, good development opportunities. And we're starting to see the leading edge of that. We've seen a couple of the established producers start to put capital to work and taking over development stage opportunities. Kinross did it recently, Yamana did it recently, and they're starting to fill out their pipelines again. They're doing it very, very selectively and carefully, but it's unavoidable and inevitable that they have to do that given the downward trajectory we've seen in reserves over the last 8 or 10 years.
I think we got time probably for one or two more questions, so let me go to our audience here. Question: does Marshall Precious Metals and or Gold Royalty Corp offer any mine development expertise in terms of decision to mine at final economic study?
I would say in both cases, no. I think what we're providing is a source of capital and a consistent source of capital. In Marshall Precious Metal, we've been capitalized, at least initially, with a significant investment from Zhaojin Mining. They're not taking any preemptive rights in any of the investments that we're making. We're running this like any other independent fund is being run. But what we're doing is providing consistent funding for grassroots exploration, early stage reserve calculations and whatnot. And we've been consistently supporting some of the juniors in the space who've had an exceptional track record on the exploration side. Gold Royalty Corp, our intention is, one, to accumulate royalties, provide capital for mine development, but we're not going to staff out to provide that kind of expertise, engineering or otherwise, to build these projects out. What we're providing, what we hope to be providing, is a competitive source of capital in terms of cost of capital to these development stage companies to build out their portfolios.
One last question from me, and being based in Hong Kong, a little closer to home. Zhaojin involved with Marshall Precious Metals. Have you found working with a Chinese gold company, a Chinese state-owned enterprise gold company?
Well, what I would say about Zhaojin is it is a state-controlled SOE. It's publicly listed on the Hong Kong Exchange, and as such, they don't have to go through as many hoops to make capital allocation decisions. And I found them astoundingly fast in making the decision to set up Marshall Precious Metal. I got involved with them over a year ago on a consulting basis, looking at some M&A opportunities in the North American space. And they asked me to set up an incubator fund for them to get involved further down the food chain and start to put some risk capital work in early stage opportunities with a long-term investment view in mind. If they want to get into the if they want to diversify outside of their domestic production in China, they recognize that they had to make some early stage bets, and they liberated that capital within weeks of the conceiving of this incubator fund. And we've been putting that capital to work in a fairly consistent basis for the last year. 2/3 of our investment committee is actually outside of Zhaojin. So it's professionally run fund. And Zhaojin really doesn't spend any time on the day-to-day here. So really we're quite independent. And if anything, if we're successful, they've stated to us they'd love to put more capital to work with us.
Great. Well, look, Dave, our 20 minutes has run by very quickly as I expected. So we're going to need to wrap up. But wanted to say thanks. Great to see you on the other side of the world. Looks like you're right next to me. And great discussion. So thanks for taking part in this. And thanks to Minds of Money for giving us an opportunity to have a good chat. So thanks, everyone. And thanks again, Dave.
Thank you.